Hello, this is Cameron Denny with Keller Williams Realty in Burlington, North Carolina, and this is Real Estate Wisdom. Now today we're talking about step 2 of the home buying process, which is lending. Lenders, this is going to be a bank or a mortgage broker, and they're looking at your financial situation to decide whether they want to give you a mortgage. They're going to be using a rule. It's a rough rule, but it's pretty well known across the industry. It's called the 28-36 rule. This means that 28% or less of your monthly gross income needs to go towards housing. And we'll define housing here in just a minute. Okay, but they're looking at your monthly gross income, not more than 28% is going towards housing. On the other side, they're looking at your total debt, okay, car payments, credit cards, personal loans, all of that, and your housing expenses combined. So your total debt burden, not more than 36% of your monthly gross income. Now, housing expenses are defined across several categories. You have principal. This is the money that goes towards lowering your total loan amount every month. You have interest. That is the money that goes towards the bank for the privilege of having a loan with them. You have taxes. So this is your annual property taxes divided by 12 to get the monthly. And then your insurance, annual home insurance premium divided by 12 to get monthly there. And then also if the home has any homeowner dues or association dues, that also goes into it. So all 5 of those factors combined equal your housing expenses, and those need to be less than 28% of your monthly gross income. So let's take an example. Joe, he brings home $5,000 a month. He needs to have a total debt burden of less than $1,800 a month, and he needs to have a housing burden less than $1,400 a month. So if he has zero debt, he still can only afford $1,400 a month because he has to jump through both hoops. If he has $700 worth of car payments and boat payments and credit cards, so the $700 a month, he takes his $1,800, subtracts $700 from it, and he can only afford $1,100 house. Okay, so have to jump through both hoops. Now, when you're talking with lenders, you want to be getting a pre-qualification letter or a pre-approval letter. Every bank has a little bit different name for it. But this is a letter that gives you your up to amount. So up to 150, up to 250, up to 350, whatever it is. It gives you a budget that you can work with so that when you get to the home buying step, you know that you're working within your framework of what you can afford. Now, when you shop with a lender, I would recommend talking with 2, maybe 3, 4, or 4 lenders. You need to make sure that you're working with somebody that's a high level of integrity, that does what they say they're going to do on time. And if you don't know who those people are, talk to me. I get to work with a bunch of different ones. I can recommend some. When you talk with these people, you want to give them the information they need to get a pre-qualification letter so that you have your budget, you can move on to the next step. This is so important. You need this before you go shop for homes, because otherwise you're going to fall in love with one and you can't afford it.